So in the latest development of international taxation, our government, not our government basically, like OECD and all, they have introduced one new concept that is called BEPS 2.0. BEPS 2.0, that is Base Erosion and Profit Shifting 2.0. Now guys, 2.0, if you remember the BEPS, then you know that in the BEPS there are 15 action plan. Plan number 1 is related to the digital economy, and due to that equalization levy was introduced and all, that was BEPS action plan number 1. As well as you know that after that there was a BEPS action plan number 4 was related to the transfer pricing theme capitalization. So that all was BEPS action plan. There were 15 plan. Now guys, after BEPS 1.0, that BEPS 1 also, there are various company, they used to evade the tax. They used to shift the tax to the country where tax rate is very less, or you can say that tax haven countries, and overall their tax burden is very less. Now there are various company, they are actually doing the business digitally. That is, example is Facebook, Google, as well as all other Twitter and all. So they are earning the income from various countries in the world, but they are not paying the tax in those countries. So just mitigate that defect, they have introduced one concept is called BEPS 2.0. And guys, this BEPS 2.0 is a landmark agreement. Like 137 countries made this agreement. And this agreement is made on the 8th of October 2021. And guys, 137 countries agree to follow the BEPS 2.0. And this BEPS 2.0 is just to remove the defect where that company doing the digital business, they are not paying the taxes and all in the country where they are generating the income. So just to remove that defect, they have introduced the BEPS 2.0. Now what is the BEPS 2.0? We will discuss. All people pay attention. So here, introduction of the two pillar solution in BEPS 2.0, they have mentioned two pillar. Now pillar 1 is related to the profit allocation and nexus, and pillar number 2 is related to the minimum taxation, and they mention that multinational group has to pay at least 15% tax in all world, means whole world they have to pay the minimum tax that is given in the pillar number 2. We'll discuss pillar number 2 in the later part. First we will discuss about the pillar number 1. Now 137 countries and the jurisdiction have joined the landmark agreement on the two pillar solution to address the tax challenges arising from the digitalization of the economy on the 8th October 2021. So guys, this BEPS 2.0 is having the two pillar solution, and this two pillar solution they have introduced to address the tax challenges arising from the digitalization of the economy on the 8th October 2021. Now what is the pillar number 1? All people pay attention. Pillar number 1 is very simple pillar. Now what pillar number 1 says that? Pillar number 1 says that, for an example guys, there is a one multinational group. So for an example, there is a multinational group and that MNC name is a Unilever Limited. Now guys, Unilever Limited is earning income. That income is, suppose that income is basically more than 10%, means their profit margin, that is profit before tax divided by total revenue. So profit before tax divided by total revenue. Suppose their profit percentage is more than 10%. For an example, suppose their profit percentage is 22%. So guys, they are saying that 10% profit is basically routine profit. That is the routine profit, no issue. But guys, whatever profit in excess of the 10%, so here in this example, your excess profit is at 12%. Now guys, out of the 12%, 25% of the 12%. So 25% of 12% comes to the 3%. 3% profit we will allocate to the countries from which you are getting the income, and you are not paying the taxes in that country due to this pillar number 1, due to that BEPS 2.0 pillar number 1, this 3% profit we will allocate to the country from which you are earning the income. And their nexus, there is a nexus test, and after nexus test and after revenue sourcing rule, we will like distribute or allocate that profit to that country, and that country can charge the taxes. Now for an example guys, I can take an example. There is a one group, name is a Unilever. Now, Unilever total profit, MNC, that multinational company, their total profit before tax divided by revenue, that comes to the 22%. So out of 22%, 10% is your routine profit, no issue. Now guys, in excess of the 10%, so remaining is your 12%, and out of this 12%, 25% profit, means out of this 12%, 25% of 12%, that comes to the 3%. This 3% profit will be allocated to the countries from where you are getting your revenue. Means if nexus test is fulfilled, then we will allocate that profit to those countries, and that countries can collect the taxes on that profit. So this is basically your BEPS 2.0 plan and pillar number 1. And pillar number 1 is basically profit allocation and nexus. Even your physical presence is not in those countries, then also your profit will be allocated to those countries on the basis of the nexus rule. So pay attention. Pillar number 1 says that Pillar 1 is a significant departure from the standard international tax rule of the last 100 years and move away from the idea that taxation largely requires a physical presence in the country before that country has a right to tax. So guys, from last 100 years, what we are doing? Like country can charge the tax only when you are having the physical presence in that country. But guys, now due to this pillar number 1, even there is no physical presence, then also that country can get the right to tax your income. So here, pillar 1 apply to the multinational group MNC that have the more than 20 billion euros. More than 20 billion euros of the global turnover, and their profitability is more than 10% measured as profit before tax divided by the revenue. So guys, here this pillar number 1 concept is applicable only to the MNC or multinational company which is having the global turnover of 20 billion euros. So guys, 1 billion is basically 100 crore. 20 billion is 2000 crore euros, and 2000 crore euros multiply by, if you multiply by the 90 rupees is 1 euro rate, then you will get in the Indian currency. So if their global turnover is more than that, then only this pillar 1 is applicable, and their profitability is more than the 10%, then this pillar is applicable. Now foreign scope group, 25% of profit above the 10% profit margin referred to as the amount A will be subject to the reallocation to the market jurisdiction based on the formulary approach. So what will happen? Just here try to understand, there is a amount A. So amount A, how this amount A will be allocated? So try to understand. So guys, here first is the routine profit. So your routine profit is a profitability threshold is 10% of profit before tax divided by turnover. So 10% profit is your routine profit, no issue. But guys, whatever your residual profit, out of this residual profit, your 25% profit allocated to the market jurisdiction, and this is known as the amount A. Market jurisdiction means, I can take an example. Suppose Unilever is basically, or for an example, we can take an example of the Facebook. Now Facebook is based in the USA, that is the USA company. Now from whole world, if their turnover is more than the 20 billion euros and their profit percentage is more than 10%, then what will happen? You know that 10% profit is, but profit before tax divided by revenue, profit before tax divided by the revenue. So that is more than 10%. So 10% is routine profit. Now in excess of 10%, whatever the profit, out of that profit, 25% profit will be allocated to the countries, from where they are getting their revenue, means where they are having the nexus test is fulfilled, then this profit will be allocated to those countries. For an example, they are getting the income from India, and in India they are not paying the taxes, then guys, their 10% profit is routine profit, above 10%, and in above, out of that above, 25% profit will be allocated to those countries on the nexus test basis. So you understanding of what they are doing. So they are saying that suppose if there is any multinational companies, and multinational companies, their total turnover of the global turnover is more than the 20 billion euros and their profit is more than 10%. 10% is a routine profit. Guys, in excess of 10%, whatever excess profit, out of excess, 25% profit will be allocated to the other countries. Even in those countries, they don't have any physical presence. But guys, from those countries, they are getting the income. Suppose they are sourcing the revenue from those countries, then those countries will get the right to tax that profit. You got my point or not? not? Yes. So here you understand this part. Okay, 10% is routine profit. In excess of 10% means that is called your residual profit, and out of this residual profit, 25% profit will be allocated to the market jurisdiction. But how this allocation will be made? Try to understand. So allocation of amount A is majorly based on the following two factors. One is the nexus test and one is the revenue sourcing rule. Now this profit, that excess profit, that amount A will be given to which countries, guys? So that will be depend on the nexus test. Now what nexus test says, try to understand. Nexus rule apply solely to determine whether the jurisdiction qualified for the profit allocation under the amount A or not. Means which country will get that profit allocation, and which country will charge the tax on that profit allocated. So here, this rule will not alter the nexus for any other tax or non-tax purpose. Amount A is allocated to the market jurisdiction only if the nexus exists, and to determine whether the MNE in scope amount A satisfied the nexus test for amount A is in jurisdiction, it will have to apply the revenue sourcing rules to identify the jurisdiction in which revenue arise for the purpose of amount A. Now guys, this profit, whatever that excess profit, out of excess 10% is routine, and now in excess of 10%, and in out of that excess 25% will be allocated to the other countries. But guys, this will be allocated only to those countries from which this MNE is getting market revenue threshold, and their market revenue from that country is greater than or equal to 1 million euros. When that country's GDP is the more than 40 billion euros. That country GDP is more than 14 billion euros. And guys, suppose if that country GDP is equal to or less than 40 billion euros, then guys, from that country they are getting the revenue that is 2,50,000 euros. Only to those countries they will allocate the tax, allocate the income. So guys, in simple word, try to understand. Suppose for an example, there is a Facebook. Now suppose Facebook, obviously for a year, Facebook global turnover is more than 20 billion euros. Now Facebook profit is suppose 22%. So what will happen? So out of 22%, 10% is routine profit. Now in excess of 10% is 12%. So out of that 12%, 25% comes to 3%. 3% profit will be allocated to the different countries. Even in those countries, they don't have the permanent establishment, or they don't have the physical presence. Then also that profit will be allocated to those countries. And guys, this profit will be allocated to those countries. So which country will qualify for this allocation? So here condition is satisfied. And what is the condition? Suppose Facebook is getting the revenue from that country, and that revenue is more than 1 million euros. If that country's GDP is more than equal to 40 billion euros. And if that country GDP is 40 billion euros or less, then revenue from that country is a 2,50,000 euro, 2,50,000 euro, then that country will get right to tax on that excess profit. You got my point or not? Yes. It transferred taxing right over residual profit to the jurisdiction with business activity regardless of the physical presence. Revenue sourcing rule means revenue will be sourced to the end market jurisdiction where goods or services are used or consumed. So where basically like Facebook goods or services used in the India. So India will get the right to tax on that excess profit. Excess profit means not more than 10%, like more than 10%, but in excess of 10%, and out of that excess only 25%. That will be treated as your allocated profit. Now what will be the process? Determine the revenue category, identify various transactions in each category. Using revenue based allocation key, apply sourcing rules to the identify the market for revenue in category for transaction by transaction basis, and in absence of the specific allocation key, use the appropriate allocation key to the source revenue to the market jurisdiction. Now guys, this is the very new concept. Still it is in the developing phase. Now what you have to remember from the pillar number 1. Pillar number 1 is basically your profit allocation and nexus. You can remember that pillar number 1 of the BAPS 2.0 is a profit allocation and nexus. Now what this pillar says, when this pillar will apply? This pillar will apply to a multinational group when their global turnover is more than 20 billion euros, billion euros, and guys, their profit is more than 10%. If that condition is, both condition is satisfied, and suppose their profit is more than 10%, then 10% is routine profit, and profit before tax divided by revenue. Profit before tax divided by revenue. If that is more than 10%, 10% is routine profit. Now in excess of 10%, whatever excess profit, out of that excess profit, 25% profit will be allocated to the different countries. But which country will get that profit? You know that only if nexus test is fulfilled, and your nexus test is fulfilled when market revenue from those country, if that country GDP is more than equal to 40 billion euros, and this company is getting the revenue from that country is more than equal to 1 million euros, and suppose if that country GDP is 40 billion euros or less, and this company is getting revenue from that country is a 2,50,000 euros, then guys, that country will get the right to taxing that particular excess profit. You got my point or not? Yes. Now guys, so just you have to remember little bit. Now from this particular topic you can get the MCQs in your examination. Now which type of MCQ you will get? You know that I have shared certain MCQ, yeah. So this all are MCQ I have shared. This MCQ is from the ICI only. So ICI has issued the MCQ. They have given on their board of study portal. So here guys, in this topic, they have given 5 MCQs. So here, this all 5 are MCQs. Okay. So first check the MCQ number 2. Now what MCQ number 2 says that? MCQ number 2 says that in scope, companies are MNC with, means when this particular pillar 1 is applicable, when global turnover is more than 20 billion euros and profitability is more than 10%, but profit before tax divided by revenue. So can I say that C will be the correct answer here? Here C is your correct answer. Here C is your correct answer. So that is the question number 2. Now question number 5. Now question number 5 says that amount A. Amount A means whatever your profit, so 10% profit, in excess of 10%, and out of that excess 25% will be the amount A that will be allocated to the various countries. So here guys, 10% of residual profit that will be allocated to market jurisdiction, or 15% of residual profit, or 20%, or 25%. Guys, right answer is 25% of residual profit. So whatever 25% of residual profit, that will be allocated to the market jurisdiction from where they are getting the revenue. You got my point or not? Yes. So for the question number 5, your answer is D. So D is the right answer. Done. Now guys, we will discuss about the pillar number 2. And guys, this is all about, we have discussed now that excess profit, that is like amount A in this pillar 1. Now amount B, simplify the existing transfer pricing rules for all taxpayer. So in amount B, they mention about the transfer pricing rules, and they have simplified the transfer pricing rule. No need to remember. Now we are going to start with the pillar 2. And guys, pillar 2 is your global minimum taxation. And in pillar 2, they have introduced 2 type of rule. One is the GLOBE rule, or I can say that the global anti-base erosion rules. And one is your STTR. STTR means subject to tax rule. Now what is the GLOBE rule and what is the STTR rule? I am going to explain you. Try to understand. GLOBE rule says that whenever any multinational group, and that multinational group revenue is at least 750 million euros. Here rule number 2, that pillar 2 is applicable only to the multinational group when their revenue is a 750 million euros. And guys, that pillar 1 was applicable when their revenue, that turnover was more than 20 billion euros. But here pillar 2 is applicable only when their group revenue is like 750 million euros. Now guys, what this rule says that there are 2 type of rule. One is the GLOBE rule and one is the STTR. STTR means subject to tax rule. Now GLOBE rule says that if there is a multinational company then in every country, in every jurisdiction, they have to pay the minimum tax of 15%. They have to pay the minimum tax of 15%. Suppose if they are paying the lower tax, means suppose they are paying the 10% tax, then that country has the right to charge the top-up tax, that is called your 5% will be top-up tax. Because minimum tax is 15%. So for an example, I can take one example. There is a one multinational group, and the multinational group name is a Unilever. Now Unilever is paying suppose 5% tax in Dubai. In Dubai, tax rate is 5%. They are paying 5% tax in Dubai. That is less than your effective tax rate. Like 5% is effective tax rate. That is less than 15%. So here 10% will be the top up tax that can be charged by the Dubai government. So Dubai government may charge the 10% top up tax. So that is called your Globi rules. Now guys, there is a one more rule that is called STTR. STTR is a subject to tax rule. Now what is the subject to tax rule? The subject to tax rule says that whenever any associate enterprise made the payment, means one associate enterprise made the payment to the another associate enterprise, then guys, there should be a minimum STTR rate is a 9%. Suppose for an example, one company is located in India and one company is located in UK. Example is Unilever UK, and in India Hindustan Unilever. Hindustan Unilever made the payment to the UK Unilever. Then guys, when there is an intercorporate transaction, or you can say that with the associate enterprise transaction, then minimum that TDS rate, or you can say that tax rate, should be the 9%. This is called your STTR. So here in the second pillar, you will understand two type of rule. One is the Globi rule, that is global anti-base erosion rules, and one is the STTR, that is subject to tax rules. And guys, Globi rule says that in the every jurisdiction, that company MNC has to pay the tax at the rate 15%, means minimum tax is the 15%. And STTR rule says that whenever payment is made between the associate enterprise and all, then that should be subject to at least 9% minimum rate. That is called your STTR. Now what this point says, try to understand. Pillar 2 rule, subject to thousands of multinational group around the world to a global minimum tax of the 15%, or you can say that Globi rule. Critically, every jurisdiction in which the group has operational will need to be looked at separately to see if its effective tax rates falls under 15% or not. If so, then top-up tax will be need to be calculated and paid. Additionally, a specified payment made to the related party, associate enterprise, and the taxes below 9% may be subject to the new withholding tax, that is called STDR. Pillar 2 will apply to the multinational group only when the revenue is at least 750 million euros. Now guys, subject to tax rule or STTR. Now what is the STTR? Now STTR works in priority of the Globi rules. STTR is a treaty-based rule that enable developing country, that is source jurisdiction, to tax certain intercompany payment at source, which are subject to the nominal corporate income tax at rates below the STTR minimum rate is 9%. Applicability, when this STTR is applicable. So here, STTR applicable only to covered payment. Covered payment means, like you can say that the passive income. On the passive payments, this will be applicable by an entity of the developing country made to the group entity in the another country, or you can say that connected person. And guys, it apply only if the total sum of the covered income arising in source country exceed the threshold of the 2,50,000 euros or 1 million per year, depending on the GDP of that country. So guys, this STTR will apply only if from that country they are getting the revenue that is more than 2,50,000 euro or 1 million euro, depends on the GDP of that particular country. Now what is the meaning of covered payment? So here STTR is applicable in case of covered payment. What are the covered payment? So covered payment constitute the interest or royalty or payment for distribution of right for product or service, insurance or reinsurance premiums, payment of the guarantee or financing fees, renting payment for industrial, commercial or scientific equipment, payment for services, etc., etc. Now connected person are defined to have legal, direct or indirect ownership of more than 50% of the interest or de facto control relationship. Just remember associate enterprise. Okay, that is called your connected person. Now you can understand the STTR. What is the STTR? I can take an example. Suppose guys, there are two countries. One is the country A and one is the country B. Now country A is a developing country. Example, suppose country A is India. India is developing country. And country B is suppose Japan. Japan is your developed country. Now what happened? In India, there is a one company, name is a company A, and in Japan there is a company B, and both are connected person, both are associate enterprise. Now what happened? Suppose this Japan company B, they have given one license to use the trademark to the Indian company. Now they are paying the royalty. like Indian company, company A is paying the royalty to the company B in the Japan. Now guys, suppose Japan is charging the nominal tax rate is only 1%. Now Japan charging the nominal tax rate of only 1%. And guys, as per the tax law, suppose India is deducting the TDS only at the rate 5%. India deducting the TDS at the rate 5%. So in Japan, the royalty is taxable at the rate 1%, and in India, suppose they deducting the TDS at the rate 5%. Now here STTR says that minimum tax should be 9%. So it means suppose 1% here in the country, that is Japan, and 5% TDS is deducted on that payment in India. So total is the 6%. So it is below the 9%. So 3% will be the STTR. Subject to tax rule says that here 3% more STTR will be deducted by the company A in India. So Indian company will deduct the more TDS, or in simple word I can say that they will deduct the 3% more TDS. So it will be treated as the STTR. You got my point or not? So here pay attention. So country A and country B is incorporated in STTR provision and their tax treaty. STTR rate is 9%. Now guys, nominal tax rate applied in the resident jurisdiction, country B is charging tax only 1%. Now guys, taxpayer jurisdiction, that is country A, retain the 5% withholding tax, that is the TDS. So guys, here total is 6%. Now STTR specified rate, country A to tax under STTR at the rate 3%. So here India will get the right to charge 3% taxes, means additionally they will deduct the 3% more TDS on that payment. You got my point or not? Yes. So that is called your STTR rule. Now guys, we are going to start with one very interesting point. That is, in pillar 2 consists of the following rules, that is Globee rule. Now guys, in the Globee rule what happened, I can take one example and from example try to understand. Suppose for an example, there is a country X. Instead of country X, I am just taking the example of the UK. Now guys, in UK there is a one parent entity. UPE means ultimate parent entity. In UK there is a one company, that is UUL, that is UK Unilever Limited. Unilever Limited is from UK. Now guys, this UK is having one company in India also. So suppose in India they are having one company is a HUL. In Pakistan also they are having one company in the name of the PUL, Pakistan Unilever Limited. And guys, they are having one company in UAE also, in Dubai also. And in Dubai that company is known as the Dubai Unilever Limited. So Dubai Unilever Limited, DUL, Dubai Unilever Limited, they are having one company in the Dubai also. So guys, try to understand, there is a one Unilever group. Unilever group parent entity is located in UK, that is known as the UUL. Now in India they are having the HUL, in Pakistan they are having the PUL, in Dubai UAE they are having the DUL. Now guys, you know that from this pillar number 2 says that as per Globee rule, in every jurisdiction, multinational company, multinational group should pay at least 15% tax. That is, minimum tax is 15%. Means they should pay the minimum 15% tax in every jurisdiction. Now guys, question is that, sir, when you are saying 15% tax in every jurisdiction, so under that jurisdiction or under that country, suppose they are having the 2-3 company of same group in that country, then question is that, is profit as well as the, suppose there is a loss and revenue, means profit, whatever the tax they are paying basically. So tax and profit, question is that, is we will do the blending or not? Means for an example, I can take one example. Suppose Unilever group of the UK, and Unilever is having 2 companies in India. One is the Hindustan Unilever. Suppose they are having one more company in India. So when they are having the 2-3, same group is having the 2-3 company in India, and in India their tax should be at least 15%. So question is that, to check that 15% effective tax rate in India, question is that they are having the 3 company in India. So all 3 company that profit, because tax divided by profit we have to check, tax divided by profit we have to check. So tax divided by income, you can say that. So whatever the tax and income, question is that we will do the blending or not, means we will aggregate that profit and loss or not. Right answer is yes. So jurisdictional blending is allowed. Jurisdictional blending you will do, and after that you will check that is effective tax rate is below 15% or like 15% or more. If it is a 15% or more, there is no issue, but if it is a below 15%, then that country will charge the top up tax. You got my point or not? Yes. Now try to understand this point. All people pay attention. What happened? Now only last 5 minutes. There is a one company in UK, name is the Unilever Limited, UUL. Now guys, what happened? They are having one company in the UAE, Dubai, that is DUL, and you know that Dubai is a low tax jurisdiction country. Dubai is a low tax jurisdiction country. Now guys, suppose in Dubai tax rate is 5% only. In Dubai tax rate is 5%. But now as per the pillar 2, minimum tax rate is 15%. So can I say that they will ask Dubai to charge the 10%, they will ask Dubai to charge the 10% additional tax that is known as the top up tax. And this top up tax will be known as the QDMTT. This top up tax, if it is charged by Dubai only, then that 10% tax, whatever they are charging, that will be known as the QDMTT. Now, what is the QDMTT full form? QDMTT full form is the qualified domestic minimum top up tax. Qualified domestic minimum top up tax, because they are charging 5%, but minimum tax should be the 15%. So they are charging only 5%. So that domestic tax will be 10%. That 10% will be known as the QDMTT, that is qualified domestic minimum tax. QDMT also you can say. So here try to understand. The QDMTT imposed a jurisdiction top-up tax on the constituent entity located in low tax jurisdiction. It allowed to the low tax jurisdiction, that is Dubai, to collect the top-up tax computed in accordance with the Globee rule. Now QDMT provides the right to the low tax jurisdiction to collect the jurisdictional top-up tax by way of the introduction of the QDMT in its domestic tax law, and this would preserve a jurisdictional primary right to taxation over its own income. So basically here Dubai will charge the 10% more tax because 5% they are charging, but now as per the pillar 2, minimum tax should, as per Globee rule, minimum tax should be the 15%. So they are charging 5% tax, so 10% will be the top-up tax that is charged by the Dubai only. That will be known as the QDMT, that is qualified domestic minimum top-up tax. But guys, suppose for an example, Dubai is not charging the top-up tax. Dubai is not charging the top-up tax. Dubai is charged only 5% tax. There is no Globee rule related law in Dubai. So Dubai is not charging that 10% tax. Then guys, this rule says that here UK will charge that 10% tax. Means whatever income earned by this Unilever from Dubai, so on that amount guys, UK will charge that 10% tax, and this 10% tax charged by the UK, that will be known as the IIR. IIR means income inclusion rule. Income inclusion rule. So here IRR imposed a top-up tax on the parent entity in respect of the constituent entity located in low tax jurisdiction. A constituent entity, that is the ultimate parent entity of M&E group located in Globee implementing jurisdiction, that own directly or indirectly the ownership interest in the low tax constituent entity at any time during the fiscal year, shall pay the tax in an amount equal to its allocated share of the top-up tax to that low tax jurisdiction entity for the fiscal year. So in simple word guys, it's very simple. There are two types. One is that is QDMT, and now we are discussing about IRR. Now what is the QDMT? QDMT is, suppose Dubai tax rate is only 5%, minimum tax should be 15%. So Dubai charge the excess 10%, it will be known as the QDMT. But suppose Dubai is not charging the QDMT, then guys, UK will charge the IIR. UK will charge the IRR, that is income inclusion rule. Now guys, suppose like Dubai is not charging the QDMT, UAE, that UK is not charging the IIR, then guys, they have given the right to India and Pakistan, and India and Pakistan, they will charge the 10% taxes on whatever income, income of the Dubai company. On that income, like India and Pakistan will charge the tax, that is known as the UTPR. That is known as the UTPR. UTPR means under tax payment rule. So this is very difficult part, UTPR, because Dubai is not charging the top-up tax, as well as the that UK parent entity, that country is also not charging. In that case, that suppose they are having the constituent entity in the other country, so other country will get the right to charge the tax, that 10% tax. So here UTPR impose deduction or require an equivalent adjustment to extent of low tax income of the constituent entity is not subject to tax under IRR. UTPR is triggered where the UP that ultimate parent entity jurisdiction does not implement the IIR or does not adopt the Globee rule. Thus, UTPR serve a backstop to IIR. UTPR transfer the levy of top-up tax to the other constituent entity of MNE group located in the jurisdiction where the Globee rules are implemented. So suppose in India, Pakistan, Globee rule is applicable. In that particular case, India, Pakistan can charge that much taxes. You got my point or not? Yes. So this you have to remember. Now guys, as per the pillar number 2, that minimum tax rate on every constituent entity, every country, they have to pay minimum 15%. Suppose in any low tax jurisdiction country it is below 15%, then there are 3 ways to collect the taxes. One is the QDMT, means that country can charge the top up tax. If that country is not charging, then parent country can charge the top up tax. If parent country is also not charging, then other constituent entity is having in different country where this Globee rule is applicable, then that country will charge the top up tax. You got my point or not? Yes. Now guys, how you will calculate the effective tax rate? Because if your effective tax rate is below 15% now, effective tax rate is below 15%, then only this Globee rule is applicable. So here, effective tax rate means the Globee rule will operate to impose the top-up tax using the ETR test that is calculated on the jurisdictional basis. If the jurisdictional ETR is below the 15% minimum rate, the jurisdiction is treated as a low tax jurisdiction and the constituent entity are treated as a low tax constituent entity. Now ETR means here total of the adjusted covered taxes of each constituent entity located in jurisdiction. So guys, like in Dubai, what is the total amount of taxes divided by net Globee income of that jurisdiction? What is the income from Dubai? So what is tax paid in Dubai and what is the income from Dubai? So here you will get the ETR, that is effective tax rate. Now net Globee income, so Globee income of all constituent entity minus Globee losses of all constituent entity. So guys, in Dubai, suppose there are 3-4 entity, so just take the income and losses and you have to take the net Globee income and net taxes. So taxes divided by Globee income. So here you will check the net Globee means that constituent entity income, na yaar, Dubai income. So in simple word, whatever, like suppose there are 4 companies in Dubai. So in that case, 4 companies, what tax they paid, just do the aggregate and divide by the what is the total income of that 4 company, just divide that and you have to calculate the effective tax rate. If effective tax rate is below 15%, then only Globee rule is applicable. Now guys, you can do the jurisdictional blending. Answer is yes, you can do the jurisdictional blending. I already explained. The ETR computation is determined on the jurisdictional blending basis. Jurisdictional blending allow all the profit, losses, taxes of the constituent entity of the MNE group located in same jurisdiction to be blended for the purpose of effective tax calculation. For the purpose of determining the applicability of Globee rule, guys, Globee rule is applicable or not? For that purpose we have to check the global revenue. But guys, here for the effective tax rate calculation, we will calculate on the jurisdictional basis, means for all countries we will check separately. Now substance based income exclusion, you can ignore this point, not like you will not not more important for your examination. That is substance based income exclusion, just ignore that. Okay, now what is the top up tax? Top up tax is basically, in simple word, top up tax is your minimum tax should be the 15%. Suppose for an example your tax rate is below 15%, then obviously that remaining is your top up tax. So on excess profit you have to apply the top up tax percentage. Top up tax percentage means minimum rate is a 15% minus effective tax rate, suppose 5%, so 10% is your top up tax. Now one more point guys, this is top up tax is not applicable. This top up tax is not applicable on any a country from which their revenue from that jurisdiction is less than 10 million and average Globee income or loss of such jurisdiction is less than 1 million. So in simple word guys, for an example, Unilever is having one presence in Nepal also, but in Nepal they are getting very less revenue. From Nepal, they are getting very less revenue. So guys, from Nepal, suppose their revenue is less than 10 million euros, and from Nepal their profit or loss is less than 1 million euros, then guys, there is no need to check that. There is no top up tax and all, that is not applicable in the Nepal. So in simple word, suppose any multinational companies from any country, their revenue is less than 10 million euros and their profit is less than 1 million euros, in that particular case, like, that concept is not applicable. There is no need to check the minimum tax and top up tax rate and all, that is not applicable. Okay, so done. So this is all about this question, this topic. Now guys, from this topic you can get only MCQ. I feel you will get the 1 or 2 marks MCQs. Obviously you will not get the practical question or any big theory question, only you will get the MCQs. And guys, here ICAI has given the 5 MCQs. So 2 MCQs we already discussed. Let's discuss the first MCQ. Now first MCQ is a pillar 2 consists of, guys, pillar 2 of the BAPS 2.0. Pillar 2 is about the Globee rule and STTR. So here that pillar 2 is consist of the Globee rule and STTR. That is the part A, that is option A is the correct answer in the question number 1. Question number 2 we already did. Now minimum rate tax prescribed in the pillar 2. So in pillar 2, can I say that they have prescribed about the STTR and Globee rule? So as per the Globee rule, their minimum tax should be the 15% and STTR says that 9%. So 15% and 9%. So I think D is a correct answer of question number 3. Question number 3, yeah, D is a correct answer. Now question number 4. Which rule impose a top-up tax on the parent entity in respect of constituent entity located in the low tax jurisdiction? So suppose Unilever Group, one company is located in Dubai. So Dubai, if Dubai charge the extra tax, then it will be known as the qualified domestic minimum tax, that is QDMT. Suppose UK charge the tax, then it will be known as the IIR, and if India Pakistan charge the tax, then it will be known as the UTPR. So here guys, when parent entity country will charge the tax, that is known as the IIR. You got my point or not? Yes. So guys, this is the completion of your topic. So I think I took approx 1